Hi there, Emmanuel here, and today I want to describe a banker's candle and what a banker's candle is and why the banks have to trade a certain way. You know, this is why it's called a banker's candle. Sometimes you hear it called an institutional trading candle, but the banks have to trade a certain way. You know, when you trade, think of trading a little bit like an exchange. You know, like when you go to a new country. Say I want to go somewhere in Europe. Yeah, say I want to go to France or something. When I arrive in France, I might have pounds. And I might say, right, here's £10. And I want to exchange £10 for €10. So, you know, the broker, whatever, will exchange me that money and they'll take a little bit on commission. Which is the same as what Forex brokers do. You know, they'll pit you against someone else. So say like you're here, or say we're here, where this arrow is. And I think the price is going to go up, so I buy the price to go up. Yeah, somebody else thinks it's going to continue down and they sell it. They pit us against each other. So I'm taking, if it's going up, I'm taking their money. If it goes down, they're taking my money. So we can just trade off each other, you know, and then the broker takes the commissions. So the broker always wins. But the banks can't trade that way, because imagine, you know, somebody turning up at the Bureau de Change in France and saying, here's £10 million, give me the equivalent in euros. They wouldn't have it. They don't have that sort of money to exchange. Nobody's big enough to trade against the banks. So the banks have to manufacture the money in different ways. And the way they do that is by setting up these types of patterns. You know, we all hear about them: support, resistance, trend lines, you know, all this sort of stuff, you know. And this is how most people trade. So say, for example, here, I'll put an example up here. Price will start to do something like this, you know, like this line here, we will be calling this one a resistance line, and this one down here will be a support line. You can see price keeps bouncing off this. So some people are thinking, right, you know, next time it bounces off this line, like here, for example, it's going to go up. So I'm going to buy this. Now they've put their buy stop orders to go up, but where do you think they're going to put their stop loss? Here, right underneath the line. So just in case it doesn't go their way and it comes down, they'll lose a little bit of money. Now other people think it's going to go down, so they sell it. They put this on this resistance line. They put their sell stop orders. You know, they think, okay, it's gone, it's touched it twice, it's almost touched it a third time. When this comes up and touches it again, I'm going to sell this to go down. And just in case I get it wrong, I'm going to put my stop loss just above the line. And banks can see this. They can see your orders. So that's why it's manipulated. They can see all these orders mounting up. And so they think, okay, we want to drive this price back down, but we need to generate some money in order to do that. And so they produce a banker's candle. So this is what this happens now. There. That candle right there. It was actually, for a little while, it was a red candle. So it actually looked like it was bouncing and going down. So people got in. Do you know what I mean? And so this candle right here is the banker's candle. It's wicked up and it's just taken out all these people here who thought it was going to go down. All these people that have got sell stops here have lost their money. There's also going to be a lot of people who think, right, break and retest. It will break through the line, touch the line again and go up. So now they're putting orders in as well, and they're putting their stop losses just underneath the line. You know, so there's loads of orders and money accumulating around these lines that the banks can see. So they whip this up, and then the next thing they do is they start going in the direction that they kind of intended to go in the first place. As you can see, which is down. It whipped down now, took out all these people here now, and then the banks are now what we call drawdown. So that means that in order to do this, they had to push the price up to get this banker's candle. Now the price comes whipping back down, and usually they've got to come back to this to what they call mitigate, lessen their orders, because if they were buying here and then the price went down, so they're in negative, they're losing money now. Yeah, so now they push the price back up, as you can see they did with this green candle here, this little one here, back up to lessen their orders, to get themselves out of their orders, all the negative orders that they're in, and then they continue in the direction that they thought they were going to go. But this here is basically what we call a banker's candle. It's a candle that usually takes money, takes people's money, that the banks need to do, because they can't trade like you and us, because don't forget, all along these lines, we're not the only, say if you trade this way and you think, oh, the price is going to go down, there's thousands of people thinking the same thing, and thousands of people put in their stop losses here. Thousands of people put in their buy orders here and thinking the stop loss is here. So, you know, this is where the banks can just come along and just generate the money from this, because loads of people have the same ideas, you know, and it's called a retail trading. But when you start to see this, when you start to see these bankers candles, and you'll see them all over the charts. I mean, even down here, this is a bankers candle here. They just haven't come back to mitigate this, but when this comes back to around this area here, I'd be interested in this, potentially buying this, because look, the price again, like we said, can you see? Let me draw a line here. You see, it's like it's kind of touched 1, 2, it's come down 3, 4 times it's touched before taking the orders, whipping the price back up. At some point, the banks they're in drawdown here, but the banks are so, you know, this is a banker's candle. They can afford to be in drawdown for a long time, but at some point they're going to have to bring this back down and mitigate, what we call it, mitigate their orders. But this is what we mean by a banker's candle. So that's a banker's candle, and this one up here would be considered a banker's candle as well. Okay, so I hope that makes sense. If you do want to learn a lot more about this, and you want to learn, you know, how you can see these things, just like the footprints of the banks, and trade them, then we do have a free 7-day Forex training course that you can get involved in. It's completely for free. It's not giving you a credit card or anything like that. No credit card. It's actually a Facebook group. It's a private Facebook group. And if you want to get access to that, then I'm going to leave a link below this video. You just click on that, and once you've opted in, I'll personally send you the details for next week's group. It starts on Monday, 12 p.m. Eastern Standard Time, which is 5 p.m. GMT UK time. And, you know, you just get on there, and we just teach and we train and we help people to actually use the Forex market as a way to actually make money. You know, and you're going to meet some amazing traders. Some of the leaders, they're 5, 6, 7 figure earners, and they're just so giving. They really, really want to help. So if that's for you, if that's something that might be of interest to you, I'll leave a link below this video. Click on that, and I'll see you on the next training. Okay, till next time then. I hope this was helpful. You got some value from this. Till next time, you take care, and I'll speak to you soon. All the best. Take care.